welcome to our interview series where we bring you face to face with the people who manage your money. Our goal is to provide you with a glimpse into these fund managers' investment philosophies, personal beliefs, and much more. Today, joining me and my colleague Chirag is Rajeev Thakkar, CIO and Director at PPFAS AMC. Welcome, sir.
Thank you so much. Thank you for the opportunity.
To begin with, you've been in the industry for around 30 years. Can you please tell us what initially drew you to equity investing? Was there someone who influenced you? And if so, who was it?
So, two things. One is, as you mentioned, someone influencing the thinking and stuff like that. So, today we live in the digital era where everything comes to us digitally, and the annual reports are uploaded on the website, and you get an email saying annual reports have been released. But earlier, we lived in the physical annual report era. And my father was an equity investor since early 80s. We would have all these physical annual reports coming home. So the familiarity with equity as an asset class, as something that can invest in and that potentially provided better returns than the fixed income opportunities, that understanding was there from an early age, maybe since the age of maybe 8 years, 9 years kind of thing. At least the awareness of something like a share exists.
Yeah.
The second factor was what I would call spirit of the times. So a young person today typically would be influenced by the media and would have startup ambitions, saying, I'll create the next Flipkart out of India, or I'll create the next Ola out of India, or something like that, or Zomato or something. At that time, my graduation year was 1992, and that was the time when economic liberalization was happening and the stock market boom at the time of Harshad Mehta happened and all that. So any young person in my cohort would have aspirations to join the financial sector, or specifically something related to stocks.
You joined PPFAS in its earlier avatar as a PMS in around 2001, 2002. And before that, you have worked in equity research as well as in the fixed income at various or at two organizations. So what inspired you to move to PPFAS at that point of time?
94 was when I joined investment banking. That was the golden era of IPOs. So we think a lot of IPOs are coming these days. People haven't seen the early mid-90s where multiple IPOs would open on the same day. And there was a whole cottage industry of category 1 merchant bankers, as they are called. So formative years were in that space, 94 to 95. So did 2 years of investment banking, then a year of corporate finance, where basically raising funds for the organization I worked for, mainly bank lines or debt fundraising. By that time, equity markets had flattened down or were down. So post the Harshad Mehta peak that we saw, equity markets were choppy. They were not giving any direction, or they were not giving great returns. And in that period, interest rates had gone up very, very dramatically. So in 1995, 10-year government bonds were giving 14% semi-annual interest rate. And Tata Steel and L&T were borrowing money at 18% per annum. Reliance Capital was raising money at 21% per annum. So 1997 to 2001, I was largely doing fixed income securities. Although the awareness of equity, and in most companies, equity and debt people work side by side. So awareness of equity was anyway there. But the fixed income market was very, very buoyant at that time, given that starting interest rates were very high, and after that trajectory of interest rates was downwards. So when you hold long-dated bonds, not only you get that 14% interest, the bond price also appreciates. So that was a period when bond investors made something like 20% per annum. So sounds unbelievable today, but that was the kind of era. So that period I was in fixed income securities. The organization that I used to work for earlier, the founder passed away over there. And then after his passing away, the organization was in a disarray. And that was the period where 9/11 also happened. So planes went into the World Tower, World Trade Center in New York. And that was the period I joined PPFAS in beginning October of 2001. Initially at PPFAS also, I worked on the fixed income side. 2003 was when I moved to the equity. It was not that I narrowed down on PPFAS and that was the only choice or something like that at that point in time. I could have been part of another very well-known investment bank, brokerage, fund management entity, but that's the alternative indeed.
All right. Now, since we're talking about your stint at PPFAS, you joined much before the launch of the mutual fund. Can you please share how the vision for the AMC evolved with Parag Parikh?
Sure. So our initial vehicle for investments was portfolio management services. We were following the same investment philosophy that we do today, but the target market was a very narrow market. So at that time, the minimum investment required was 5 lakhs. Now, a lot of Indian investors do not have that kind of a lump sum money to start on day one with a single fund house. So, by definition, a lot of investors were out of the fold. That 5 lakh minimum investment amount went up to 25 lakhs and now it's at 50 lakhs. So it's a very, very niche product in that sense only for the affluent. So one thinking was that, we need a investment vehicle that is more accessible to the people at large. That was one thinking. The second was that we were excited by the opportunity to invest abroad, but that was not permissible in the PMS structure. So mutual fund would have been the vehicle for that. The third was the ease of onboarding. So from that time, mutual funds have had this common KYC across all mutual funds, whereas in the earlier regime, KYC for PMS was extremely cumbersome. So you had to do it in paper. You had to do a brokerage account opening. You had to do a fresh demat account opening, a fresh bank account with power of attorney signing, PMS agreement, and all of these things. So for local customers, it required as many as 67 signatures, and for NRIs who did not have a PAN account, you would potentially need up to 100 signatures for onboarding a customer. And onboarding process itself would take anywhere between 15 days to a month because everything was sequential. First, open a new bank account. After you have the bank account number, you can open a demat account. After that is there, you register a power of attorney on the bank and demat account. So it was quite cumbersome. And we said, let's move to a fund structure.
You've spent a significant amount of time with Parag Parikh. So can you please share some interesting conversations that you had with him, the values that he has imbibed that have had a lasting impact on you?
One very, very important thing about him was the first principles thinking. He would not go by convention. So just because everyone else is doing it doesn't mean it's right. Is this the way, based on logic, based on the first principles, is this the way things should be done, or is it not the way something should be done? So that was his thinking. He was not afraid of taking contrarian calls wherever required, whether in business, whether in stock investing. The other very, very key learning from him was the field of behavioral finance, where understanding psychology and understanding our own biases and what problems happen because of our biases. That was one, how to try and avoid our behavioral mistakes. And finally, if you can, try and benefit from the behavioral biases of others. So that was another key learning from him. And balance in life was not something he preached, but what he practiced. So during the work day, he would take time out for meditation. In his cabin, there would be a guitar that would be kept. He would strum it sometime. You would not feel the stress of the workplace. You would not find stock investing stressful ever. Okay. So obviously, there would be no leverage to buy stocks. Holding periods would be long. So whether the market was up or market was down, you could course along. You would not feel the stress.
Right. Any interesting conversation that you can think of right now, and probably you want to share it with us?
Plenty of conversations. So conversations would be things that would happen all the time. In a 8-hour work day, we would many times talk for 2 hours at a stretch. So conversations were there all the time. Around these subjects that I mentioned, no special one-liner that I can share with you in that sense, but basically things about wisdom in life, things about his own journey. So, for example, when India opened up to foreign portfolio investors, FIIs as they were called at that time, we were among the established Indian brokers with a good research setup, and we were the port of call for a lot of FIIs to do their brokerage transactions. Now, that was not an era of demat. At that time, there were these physical shares. And physical shares, there was a big problem of what was called bad delivery, where if the signature mismatch was there, or for whatever reason, the stamping on transfer deed was not there, or transfer deed 12 months had passed and it became stale, or if a record date had gone by, for various reasons, there would be these bad deliveries where the shares would be returned and the broker returned the shares to you if the broker had given you a buy order. Now, the stockbroker was liable for all these bad deliveries, and the capital principal amount was at risk if finally the counterparty did not honor the transaction. So there was a period where the bad delivery problem had become so much, he took a voluntary decision to stop fresh business, saying FIIs are wanting to give me orders, but I am telling them I don't want to do orders for you. Please go to other brokers. So the question to him was, why did you do that? Then he explained that people who did not take this kind of a decision in the short run did very well because their brokerage income went up, and I was looking like a fool for not participating in that. But when the bad delivery problem became so large that they had to go bankrupt for no fault of theirs, because the counterparty simply vanished, or sometimes the shares were fake, or whatever else. He used those few months where he stopped taking fresh orders to clear all the bad delivery backlog. So these were very, very important lessons in terms of survival, in terms of thinking long term, taking the pain in the short run. When you come to our office, a lot of his sayings or his sentences from his book are there on the pillars that you see in our office. So we have made graphics out of that, and those are put on pillars. So one of the key such saying is, he would say, equanimity and not genius leads to riches in the markets. So in a bull market, the thing was, don't let it go to your head. Don't think that you are extra smart, or just because you bought a stock and it's going up, it's that you are right, or everyone else is wrong, or things like that. And in a down market, don't be depressed, because eventually there's this mean reversion to the long-term trend of equity returns, whatever number that you want, 12%, 15%, whatever are the long-term averages of equity returns, things will revert to that. So don't get carried away either in a bull market or in a bear market.
Rajeev, thinking back to the start of your career, what are some of the key lessons or experience that has really shaped you?
I think one thing that a lot of young people they are under indexed to equities. So when I look back, people said, oh, put this money in PPF, put this much in bank fixed deposit, do this much in equities or whatever. Although I corrected this very early in the career, but still I feel that the long-term compounding that happens in equities, especially when one is young, one doesn't have dependents, one is in good health, there are health insurance covers from the company, then you don't require too much money in fixed income securities. Anyway, most salaried people have employees provident fund, which largely is fixed income. So I think almost everything should go in equity in the earlier days.
But just wanted to understand, in your career of 30 years, markets have seen different, has gone through many things. So what are the key changes which you have noticed over the period of time?
The world is completely different. So when we started off, one, there would be information scarcity. So companies would not report quarterly results. They would give only annual accounts. And annual account did not necessarily mean a period of 12 months. 12 months could be extended to 15 months at company's will. And with some permission, that 15-month could be extended to 18 months as well. So, and after the year ended, they would take as much as 6 months to send you the annual report. So just think about it. The annual report that you get today could potentially cover a period which started 2 years back. So, and even annual reports sometimes would get lost in post. You would have to hunt around. If you got one original copy, you would try and photocopy it for other people to be able to read it. So there was complete information scarcity. From that, we have gone into too much information these days, where filtering what is relevant and what is not is becoming a challenge. So that is one. Second is the time taken to execute a trade, the ease of transacting. Physical shares were there. There was no screen-based trading, open outcry. Today we live in an era of zero brokerage rates or close to zero brokerage rates. At that time, brokerage rates would be 2 to 3%, and again, no transparency. So most likely the transaction price in the ring would be different from what was reported on your contract note. So over and above the 3% charge, you paid an extra spread to the broker and to the jobber. Lot of time would be taken to get the shares transferred in your own name. Dividend would come by check instead of getting credited to your bank account. So if the check got lost in email, in the postal thing, then you would lose out on the benefits over there. So a lot of things have changed, I think, and all the changes have been for the better. So I think today we have a very, very different environment.
All right, now moving on to the present. Can you walk us through your investment framework? How do you decide when and what kind of stocks to add to your portfolio?
Sure. So in India, we are a bit different from the Western markets, especially the US. In the US, most companies are widely held, and if the CEO is not doing a good job, some or the other activists will come in to picture and they will try and get a different management, or if some action of the people in charge is not in favor of minority shareholders, some activism will happen. In India, most companies have concentrated shareholdings. So by what we typically call as promoters. Now, these promoters could be Indian business families, it could be the government in the case of PSUs, or it could be foreign companies in case of MNCs. Now, when these companies own anywhere between 50% to 75% of the company, there is very little that a minority shareholder can do. Because of this, it is very important to invest in companies where you have faith in the management, because later on you cannot do any activism in India. You have to live with what the promoters and the managers do. So stick with good quality promoters and management. That is the first thing to be done. The second thing is, although prospects of various industries look good at various points in time, a lot of sectors have been wealth destroyers in India. So there have been sectors where almost all the companies have gone bankrupt of a particular vintage. Now, one needs to guard against those kind of sectors where volume growth could be high, but where the pricing power is not there, or if competition is too severe, then you could end up losing money over it. So that is something to be taken care of. High level of borrowing is again something which has damaged a lot of companies. So that is to be guarded against. And finally, we look at valuations. So if the business quality is good, promoter management quality is good, we wait for the right valuation to be there before we buy.
Right now, almost all of your funds are co-managed by about 5 fund managers. So if you could explain how is the work divided and who takes care of what?
Sure. So one is when we handle public money and large amounts of money, there has to be backup for people. There has to be certain amount of built-in redundancy. So an aircraft can be flown by one pilot as such, but the other pilot is there just for safety's sake. So similarly, we have fund managers. When we have more fund managers, we can, if one person is out for a research trip or one person is on leave for whatever health reasons or emergencies, then there are other people. So that is one reason. Second is we operate in largely 2 to 3 asset classes, 2 large ones and 1 small one. So equity is one big asset class. Fixed income securities are the other asset class. And to some extent, we have REITs and InvITs. And within equity itself, we have Indian equities as well as we invest in foreign stocks. So there are people who specialize in different segments of this and bring that expertise to the table. So that's largely the function.
Rajiv, you spoke about, investing into the high quality business, but they are not always available cheap. So how do you decide when it's worth paying a premium and when it's not overpaying?
Sure. So let us take some well-known companies in India. And again, there's no stock recommendation here. I'm talking about a period from year 99, 2000 to 2007. So none of what I'm talking is relevant for 2024. I'm just giving very, very distant past examples. So let's look at companies like Infosys and Wipro. In late 90s, these were trading at bubble valuations. Now, everyone more or less has a view that these are reasonably well-governed companies. But if you buy it at 100, 150, 200 times earnings, you have factored in a lot of future growth. So despite these companies growing profits after 2000, for almost 7 years, people were not even breaking even in these stocks. Now, if we come to a period of 2007, where the fancy was in real estate, infra and commodity stocks, ironically, these stocks were available cheaply. So if you bought these at Sensex Nifty peaks, let's say on 31st December 2007 or 1st Jan 2008, and after December of 2007, in 2008, actually you saw the global financial crisis. Lehman Brothers going bankrupt and things like that. But still, if you bought IT services companies in December 2007, on a 3-year basis, you are getting a decent positive return. So even quality companies have this valuation boom and bust kind of cycle. Some sectors would be in favor, some sectors would be out of favor. So the trick is to buy them when they are out of favor.
Right now, you often say that management quality is a key differentiator between winners and losers. So in your view, what makes for a good management?
As Buffett has said, you are looking number one for integrity, right? Then you are looking for competence, and then you are looking for energy. So hard work and passion and things like that. And the most important is integrity. So if the management has this thing that I will build a castle for myself and I'll not pay any dividends to minority shareholders. I will siphon off money from the listed company that is there. And that is the approach, and obviously that is not good. Now, that is one necessary condition, integrity. But at the same time, competence is also required. Let us say a promoter or a manager is a saintly person, does not have any worldly desires, takes a rupee as annual salary, but does not have any understanding of the business, and the company is continuously losing market share to competition. There are industry changes which are not being reflected in the business strategy of the company. Then again, the company will not do well. So competence is also required. If you have integrity and competence, most of the battle is won. But then at least some amount of hard work or some amount of actual implementation work, execution is required. You cannot be playing golf all the time, even though you have integrity and competence. So being present in office and motivating your team members to do their work, to execute on the ground, that is also required. So when you have a combination of these three things, then that's the best thing. Then you are poised for success.
Rajiv, we have seen like more public sector companies in our portfolio recently in the last since 2021 and 22, like Coal India, Power Grid, NMDC, and government has proven that it's a bad owner in the long run. So, what attracted you to these investments?
Government is a very, very strange promoter to deal with in that sense. One is at one level, government has a lot of processes built in, which many times even private sector companies don't have. So as a private sector company, maybe if I'm a director, I can ask for a expression of interest, or I can put out a request for proposal and go with one bidder if I think it's a critical thing and all that. Whereas in the public sector, you have this tendering process and you have a CAG audit and all those safeguards are built in. But at the same time, many times the government may act in voter interest instead of shareholder interest. So they may do populist actions where, let's say, in 2006-07, when oil prices were very high, the oil marketing companies would buy crude at $140, $145 a barrel and not increase the petrol diesel prices, and you could have those kind of, I would say, wrong practices happening from the minority shareholders' perspective. The voters are obviously very happy, and the public at large would be very happy with such a thing. And that has resulted in what you referred to as a lot of wealth destruction happened in PSUs for many, many years. But somewhere down the road, at least my reading is that government realized these mistakes and they have done course correction. Let me give you a vivid example. Like Air India was a perennial loss maker for many, many years, but nothing was being done about it. But then there was a bold step taken saying enough is enough, we will privatize it. The oil prices came down from peaks and we had already raised petrol diesel prices, but then government felt that these companies should be allowed to make some amount of profits to recoup for the losses that they have made in the past. So at least these days you have had announcements on minimum dividend payout, some capital allocation policies and things like that. So I think there is some change that I see, but one has to be vigilant. Right now, it seems like they are a reformed promoter group, but we'll have to watch the behavior, how things go in the future. Specifically, the valuations had fallen so low that there was a change in governance in these companies. At the same time, the starting valuations became very, very low that there was hardly any downside from those companies.
Rajiv, now your international positions like Amazon, Alphabet, Microsoft have played out very well in the portfolio over the period of time. So now if RBI permits investment in them again, do you think they will still find maximum possible position in your portfolio? Do you find value there?
Depends on when the limit increase happens and what are the prices at that point in time and what opportunity we see. I would think if limits are opened up, we would see some increase in foreign allocation, and we may potentially go to the 70-30 kind of allocation, 70 in Indian equities and 30 in overseas stocks, that kind of allocation.
Right now, coming to your Flexicap fund, which is your flagship fund, it has performed exceptionally well in recent years. But last year, it lagged a bit behind its peers. So what were the main factors behind this?
So there would be various periods where we would underperform, and we have conveyed this to our unit holders. And currently, actually, I'm happy to be underperforming, which sounds like a strange thing to say. Why would you be happy about underperformance? But it's like this. See, why are we investing? We are investing to meet our financial goals. To give a sporting analogy, let us say you are batting to win the match. Right now, we are in the T20 season right now. World Cup is going on. Let us say you need to make 5 runs in 6 overs and you have 1 wicket left. Would you want to hit a 6 or would you be happy with running singles? You mentioned that longer term returns are good, right? Despite underperforming, we would be up whatever 38% for the year or somewhere thereabouts, and index would be up 40%. Or I don't have the exact number, but broadly these are the kind of numbers. Now, on an absolute basis, the 38% return is like mind-boggling. It's amazingly good. At a time when valuations are stretched, at a time when arguably some froth is there in the market, you would want to go slow, you would want to be cautious. This is not the time to hit for the fences. This is not a post-COVID situation where you want to be invested to the last rupee that you have in your bank account. Keeping some amount of cash for opportunities, being a bit conservative in terms of the stock selection, being mindful of the valuation that you pay. Those are good things to do in the market. And if the portfolio does not keep pace with the index or with the other peer group, so be it. What we are trying to do is do well across the cycle, not lose money for clients, which is what we are able to do.
Fair enough. Now, many stocks must have benefited the fund over time, but what about the ones that didn't work out? Case in point, Untitled Chapter. So, can you share some of the major mistakes and the lessons that you've learned from them?
Sure. So, firstly, let us define what a mistake is, right? And for those interested in this topic, I would recommend them to read a book called Thinking in Bets. Now, let us say we have a coin which, by experiments, by weights of the different sides of the coin, we have said that this is not an unbiased coin, this is a biased coin. This will turn up heads 70% of the time and it will turn tails 30% of the time. Now, the right strategy would be to bet on heads all the time, and you will do very, very well because it's loaded in your favor. 70% of the time you will be right, but 30% of the time you will be wrong. So, if you have bet heads and the coin turns tails, is it a mistake? Is my question. I would say not, because the right process is to bet on heads each and every time. So the outcome does not determine whether it was a mistake or not. The process determines whether you were correct in your approach or not. If you bet on tails in such a coin and the outcome was tails, even though you made money on that bet, it was a mistake. So equity investing is not like playing chess. Equity investor is like playing cards. You can see only the cards that are there in your hands. You don't know what cards other people are holding. So when you do equity investing, you can do management quality check on the past behavior. You can do industry trends based on whatever publicly available data is there. You can apply valuation filters. But can you predict whether COVID will happen or not? Can you predict what courts will do? Can you predict what competition will do? A lot of variables are outside your control. And many a times those will result in some of your investments not working out. So in any period, out of 20 stocks that you invest in, 5 may not do well. Doesn't necessarily mean your process was wrong. So does it mean that we say, okay, oh, portfolio is delivering decent returns, we stop analyzing or we stop asking our questions, what are the mistakes and what are learnings from that? No. You have to keep looking at your process and see whether you made a mistake or not. Mistakes, to my mind, are where one invests with a group where governance is not that great. That is a mistake. Mistakes are when you do not take information that is publicly available into account for your investment process, and because of that, you end up losing money. So those are the kind of things that we keep refining. The process today, I would think, is much better than what it was 10 years back. But we don't necessarily obsess over any one particular stock that worked or did not work.
Rajiv, means we found around 16% of fund sitting on a cash at this point of time. So is it because of the markets going up, or are you not finding the opportunity to invest currently? And when do you see deploying this money into the market?
Sure. So we try to invest whatever money is there, and when we don't find great opportunities, some money lies in the bank account. We don't force ourselves to invest all the times. Now, when we have surplus cash, one thing to realize is that in the current environment, we are anyway making 7.5% return, because that's the bank CD rate that is prevailing right now. So we make somewhere around 7, 7.5, 6.5, somewhere in that range. Money market deployments happen. Now, equities give, over the long run, the returns anywhere between 12 to 15%. Now, let us say instead of 7.5, equity would have given us 15. So on an annual basis, we are giving up 7.5% return on the portion of cash that is there, surplus cash. Now, in a period of 12 months, if there are fluctuations, not overall market, but on any individual stock, where some stock is down 10% for no reason because of some adverse news or some bulk selling or whatever. So these opportunities keep coming our way. Now, just a very recent example, there was one exit poll which said something, markets were up, some individual stocks were up 12-13% on that day. Very next day, those same stocks were down 13%. Now, by having this some amount of cash, can you take advantage of these ups and downs that happen? Absolutely. You can, only if you have some money in the bank account, you can do something. If you are fully invested all the time, then even if something attractive comes your way, you have no chance of benefiting from that. So there are enough opportunities which come our way in that journey of 12 months.
Rajiv, which segments of the market do you think are overheated or overvalued at this point of time?
The startup kind of companies, on an average, which have had newer listings, on an average seem expensive. Maybe one or two of them will do exceedingly well, but broadly as a group, I think they will do poorly. All the consumption-oriented names, the FMCG retailers kind of thing, are still expensive, despite them time correcting and to an extent price correcting in the last few months. Broadly, smaller companies have had larger price increases and some of them are looking very, very expensive. So these are the segments I would think are expensive.
Are there any segment where you feel they're reasonably valued and just it can be on the radar or it can be look going forward?
Yeah, some private sector banks even today are trading at pre-COVID levels. So after 4+ years, 4.5 years, profits have grown. Their valuations are very, very cheap. Balance sheets are good. There are no problems of NPAs or things like that. So that space is looking good.
Right now, what's your take on the new age tech companies that went public in India a few years ago? They're starting to focus on profitability now. So are there any of these stocks on your radar?
We keep watching them. So we haven't bought any so far, but some of them make for interesting business models and we follow them closely.
Rajeev, what advice would you give to the investors who have entered the market post 2020 when they have seen only one side rally and there are now unrealistic expectations going forward?
I think firstly, any money that you envisage needing in 5-year period should not be in equities. So equity markets don't go up linearly in one direction, although it may seem like that in the last 4.5 years, but there are many periods where equities either are flat or negative as well. So and if you are fully invested in equities and suddenly you need money, you may be forced to exit at the wrong time. So let's look at what happened in the COVID period. People who did not have any savings or any emergency corpus, some of them had job losses post-COVID and they were forced to exit equities even though that was actually the time to buy equities. So having proper asset allocation is key.
Every investor has a story about their first investments. Could you share your first investment? What was the company? How long did you hold that share and what was the outcome?
It was not very scientific in that sense, the early investments that I made. So not much of learnings from that. So some of them did well, some of them did not do well. So this was in mid-90s. I think some thinking, some process only started around 2000, 2001 kind of thing. The first investment with some thinking and process was a company called LIC Housing Finance at that time. So at that time, I don't know, it sounds ridiculous to say, for something like a 2 to 3 PE stock and was giving 10% plus dividend yield. So again, growing 20% per annum. So that period actually 2000 to 2003 kind of thing, it was like shooting fish in a barrel, or like you are standing right next to the dartboard and all you have to do is just pin the dartboard in to the bullseye. There was not much of effort that was required to make money at that point. That was a different market completely.
Today's last question, Rajeev. You've recommended one book already. So would you like to recommend some more books to our readers to help them make better financial decisions?
If people are interested in stock investing, I think Peter Lynch's 2 famous books are good. One Upon Wall Street and Beating the Street. Those are very, very accessible to the lay investor. Books on Buffett's investment principle, although he hasn't written a book, but plenty of books have been written about him.
Right.
Either reading his shareholder letters or summaries of his shareholder letters or books on him would help. And to people who are slightly more interested in getting into the details of the things, reading Benjamin Graham, The Intelligent Investor.
Thank you for this great conversation. It's time for us to wrap up this chat. We hope our viewers benefit from the insights that you've shared.
Thank you for the opportunity. Thank you.
Thank you, Rajeev.